Rescue finance will be a target of opportunity, but I couldn't have asked for a better setup to our next panel than what Dawn initially mentioned a moment ago, and that is private credit. It is one of the hottest investment areas going these days. Assets in private credit have doubled to over $1.3 trillion within just the past 5 years. It is clearly a place of opportunity for investors like you. So what is private credit? Why has it blossomed? How can you play it? And most importantly, what is next? Let's find out from Michael Arougheti, co-founder and CEO of Ares Management, Armen Panosian of Oaktree, and Damian Dwin of Lafayette Square, and the moderator, Michael Santoli, CNBC Senior Markets Commentator. Welcome, gentlemen. Welcome.
Tyler, thank you very much. And yeah, absolutely, the best unplanned opening act for us in terms of setting up private credit. You had two CIOs, CEOs who cover all asset classes, and they spent a whole lot of time talking about yours. So we're going to get to exactly the whys and the what the outlook looks like for private credit here with these practitioners. And Mike, I'd love for you to set us up with, I mean, really from the broadest possible perspective is why this asset class exists and is now growing and is so in favor.
Yeah, maybe it's a very complex global set of markets, but I would just say this is not a new asset class, so everything that is old is new again. What private credit is, just in its simplest form, is private loans to privately owned companies, privately owned real estate, and privately owned infrastructure. A lot of these loans used to get made within the banking system, regional mid-sized banks. Some of these loans used to get made within the insurance market. And really what's happening now, just based on structural changes, which were also referenced in the last panel, we've seen a 20 to 30 year increase in the amount of private lending that is happening outside of those traditional markets. You've also seen some structural changes and a move to scale in the liquid credit markets, and that's further increased demand in private markets. So I just want to caution everybody, while private credit is having a little bit of a moment, these are not exotic instruments of any kind. These are plain and simple loans. And I think because they're plain and simple and because they're floating rate and senior secured, given some of the things that are happening in the world now, they're very valuable both to the investor community but also to the economy. Right? There's a meaningful capital constraint happening right now, and the private credit markets are actually a big part of that solution. So think of this just simply as bilateral loans between a private asset or company owner and a private or publicly traded investment manager. And just viewed through that lens, these are massive multi-trillion-dollar global markets. To put that in perspective, if you look at the US economy alone, 99% of companies with 100 employees or more are private, right? That's 30% of economic output in our country. It's 30% of employment. You have 30,000 companies with enterprise values over 100 million. So if you want to invest in the US economy, you have to invest in the private markets. And if you want to invest in the private markets prudently, given where rates are and given people's inability, as the last panel talked about, to price equity risk, private credit is a really good place to be, which is why I think so many people are paying attention to it.
Armen, Oaktree has been in the business for some time, so you're not kind of newly grabbing onto it, but what is it from the end client, your end client's perspective, that makes it either attractive right now, or what explains the motivation to get more involved than they have before? Is it some things going on in the banking industry? Is it the economy, or something else?
Yeah, I think it's the exit of the incumbent lenders, the decline of the syndication activities of the banks. There is clearly a need for a replacement source of capital from pension funds, insurance clients, institution, and even retail entering that market. I think the need is quite apparent, and the returns are very attractive given the risk. Today, you're able to lend on a first lien basis at 11 to 13%, sometimes higher if you go into rescue lending or some other more complicated situations or in industries that are a little bit harder to understand. But you could be top of the capital structure, often less than 50% loan to value, even in today's market with today's assumptions in place around a potential recession. And given that risk-adjusted return, our client base is quite attracted to that area. I think also through a cycle, if you do expect volatility in either security prices or the economy, trusting an investment manager that can navigate such cycles in a way that you have uninterrupted income and stability of performance against that broader volatile backdrop is also very attractive for especially a number of our institutional clients. And so across the board, whether it's retail or institutional, we're seeing a lot of inflow.
I think that floating rate piece is so critical. The last panel was just talking about the lack of attractiveness in traditional fixed income and the risk of the back book. I think the interesting thing about the floating rate nature, you're capturing all the front end of the curve opportunity, but you're not playing so much defense in your back book because the value of those loans is actually preserved as rates have moved. And so it's a very interesting dynamic and a little counterintuitive if you're used to traditional fixed income.
Damien, how do you approach this market, the provision of capital to parts of the economy that, at least by perception and some evidence, is being underserved?
So we think about it in two dynamics. First, there's a geographic piece. We know today that half of the capital in private credit goes to 5 states. So we're a 50-state lender, not a 5-state lender. And we push this concept because we think it is diversifying. The second is we're making a big bet on labor. We believe in the American worker. And as pointed out, we've got 50 million workers today that basically live check to check. And so as a risk mitigant, we want to do everything we can to improve the employee benefits within the portfolios where we invest because we know it improves our chance of getting repaid.
How does that occur in practice when you're making a new
so
loan?
it's interesting. We think about leverage finance or private credit as a delivery mechanism for better worker benefits. So we literally have the technology and the wherewithal to go in and assess a labor pool of a company, stratify the wages for that business, study the uptake of retirement benefits, healthcare benefits, and then make recommendations to the company on things they could do to fortify their workforce. If the company follows our advice, we'll actually give them an interest rate reduction on the loan we made. So imagine going from an 11% loan to 10.75%. That's real money. The company appreciates it, but more importantly, the workforce is more productive. And there's a twin to this. It's data. We have to have receipts to prove to our investors and to the marketplace that we are actually making a difference. So it's the duality of returns and data. These are the two things we give back to our investors.
I do think that you've posed things, all of you, as this kind of win-win, but I need to know where the returns come from. Like in a capitalist economy, why are you able to get 11, 12, 13% returns if the issuer is also, if the borrower is also getting a fair deal? Mike?
I think you have to think of it from supply and demand, right? So there's definitely a constraint in the supply of capital available to these borrowers across the board and across the globe. And again, that's a function of decades of bank consolidation, bank regulation, changing regulatory capital frameworks. So again, if you go back 30 years, just in the US, we had 8,000 banks. Today we have 4,000, which is still way too many. But as these banks consolidate, all of that supply that used to find its way into the real economy actually consolidated and moved into the securities market. So there's just this overarching trend of just lack of capital availability, and that's a big part of it. But then you have to think about what's left. What do banks do well? And the types of risks that they underwrite tend to be fairly constrained. They tend to focus on the real estate market, hyper small businesses, and the consumer. When they make loans directly to middle market companies and middle market assets, it has to fit a very precise box. If you have any need for creativity or flexibility to execute on a business plan, you're probably going to find your way into the private market. So you're going to have a willingness to pay for the opportunity to generate those equity gains, and that's a big part of it. I also think that when you look at how private credit works in partnership with the borrower, and this was referenced on the earlier panel in terms of the value of control, you're partnering with these company owners and their employees to actually drive enterprise value creation. And so that incremental cost of capital is actually easily absorbed because you're creating more value. And so if you actually look at the interplay between the cost of capital and the equity value creation, I think there's a strong argument to be made that we're actually accelerating growth for these borrowers and they can actually absorb the higher cost.
I think to that I would add certainty of execution. I think especially when there are borrowers that are attempting to do something strategic, a little bit more storied, they really don't want to have to flog those competitive that level of competitive information to 30, 40, 50 different lenders or rating agencies. So certainty of execution, when a direct lender says, I will provide you $200 million, $500 million on these terms, you know it's good and there isn't a syndication process that presents the risk of that execution going sideways. And I think there is, to Mike's point about partnership, there is also certainty in a relationship as you go through a cycle. If you do see a downturn, if you do have a repeat game between a bilateral relationship between a borrower and a lender, or a lender and a private equity firm that does multiple transactions, then there is more certainty around how that process would unfold. And rather than in a publicly traded situation where you might see a piece of debt trade down 30, 40, 50 points due to sentiment as well as fundamentals. But if you do see that paper trade, what ends up happening in a restructuring scenario is that the conversation really degrades to the lowest common denominator. And the new participant, the new investor with a lower cost basis can often drive an outcome that is quite unstable for the ownership, for the management team and the employees.
Damien, how do you get beyond the notion, though, that, as the last panel alluded, that effectively you're absorbing more risk and getting compensated for it, and essentially that the risk might even be more concentrated than in other structures?
Well, I would counter that in two respects. The first is this vintage is historical. We have a Fed that has reset the economy. We've got record low unemployment. We know that, as has been said, good companies stay private much longer. In that paradigm, you can, as an entry point, put 50% leverage or less on good, growing, audited businesses today with terms that they can handle. In an environment where, back to supply and demand, their alternatives with banks are very, very limited. Their trust of institutional investors in general is light. And so when they bump into a firm that can provide them with the capital, the employee benefits resources, and can grow with them, it works. But it's interesting, you got 240,000 businesses with more than $10 million of revenue in this country. You have 30 million companies with less than $10 million of revenue, and they're all underbanked. Mm-hmm. If you took a poll of CEOs, they would say they feel access to credit is inadequate at any point on that EBITDA scale. It's stunning. Yeah. Meanwhile, the number of firms who have the track record, the trust with institutional investors and retail investors to raise this type of capital and have an appropriate asset liability match is very few and far between, because guess what? Most of us use leverage when we make these investments, and there are only so many institutions we can go to for funding. So it's interesting. Yeah. We are leaning on each other. In my view, there are no villains here. We have to rally together. This is the greatest country in the world, and we have the best labor force in the world. But the mechanism for how credit flows to our businesses, our private employers, is compromised. Mm-hmm. And conferences like this give us a chance to hopefully draw attention to this and support the winners.
Yeah, one of my favorite metrics every month, the NFIB, like Small Business Owners Survey, which we watch for the general sentiment of smaller businesses. But they have a question, and this goes back like 35 years. Do you expect is credit easier or harder to get right now than it was before, right? So it kind of goes like this in the curve, but it's literally never been positive. Right. Literally never in the history of the survey did small businesses say, yep, it's easier today than it was and I expect it to get better. So that just shows you, these are very small businesses, I should emphasize, like 80% are under 20 employees. But nonetheless, it goes to your point. I guess the obvious analogy here is, private credit is to publicly traded or bank credit as private equity is to public equity, just in the sense of, in the public markets, there's a sense of diversification. It's a little bit more of a generic exposure to the asset class. But you also have within private equity, that ongoing residual criticism of either you're just kind of benefiting from not having to mark stuff in real time, or it's a leverage effect, or the past returns were when this was a small industry, and now the forward-going returns when there's so much capital in it might not be as good. How would you respond to that, Mike?
There's a couple things to unpack in there. I think your primary analogy is a good jumping off point, and we've just said it, that good companies are staying private longer, and you can see that just in things like the time to IPO. You can begin to see it in the number of publicly traded companies, which is half of what it was a couple of decades ago. You can see it in the concentration of market cap in the public companies that was just talked about on the prior panel. You can see it in the concentration of market cap in the traded debt markets. So there is this huge secular trend to growth in private markets that can't be ignored. And so whether you're talking about private credit filling that gap or private equity filling that gap, that is real. The other thing in terms of this not valuing, again, I think that's a little bit of a false narrative. Institutional and retail investors want to be in the private market for that smoothing effect, right? I think there's a misconception that because of the technical factors in the public equity market, which are driven by retail investment, high velocity of capital, algorithmic trading, et cetera, that that's the right justifier of the value or the intrinsic value of a company. Whereas in the private market, if you have a company that is performing on plan and growing its cash flow, that stability is reflected in lower volatility in the marks. And that's actually of a great benefit to the investor. So that to me is not a huge disconnect. That just speaks to the structural differences in the public market versus the private market. But that is one of the reasons why people want to stay private longer. They don't want to have to deal with the implications of that, the amplification of the volatility.
Yeah, and I was going to say also with private equity, you will hear something similar, which is, we can, have a actual long-term relationship with the company that's receiving the capital. We can help with management. We can, obviously do a little more than just give money.
Yeah, I mean, there are a lot of similarities between private equity and private debt, but I think there's one or two critical departures. The first is, in private equity, the way you make money is either you execute really well in that industry and you really grow the enterprise value irrespective of the debt. In other words, on an unlevered basis, that business would double in value anyway. And there are some private equity firms that are quite good in certain sectors at executing just that. But the second way, and in fact, probably the more popular way over the last 10 years pre-pandemic, or the last 8 years pre-pandemic, was really through arbitraging easy access to capital, easy access to debt. And so as you did, with sequential years get easier and easier access to cheaper and cheaper debt, valuation multiples went up, dividend recaps increased, and equity arbitraging, a result that was very attractive from an IRR perspective for clients, and even on an MOIC basis was I would say fairly easy relative to historical standards, and certainly easier than it is today. The way I would compare that, however, to private credit is that you get paid to wait in private credit. You're getting paid 11, 12, 13% today. You're originating near par, but if you do a good job of underwriting and avoiding bad outcomes, stress testing your investments through a recessionary scenario, a high rate scenario, you are not subject to valuation multiples rising for you to get repaid. You're really subject to the business continuing to perform better than your downside scenario for you to be covered on your position. And if things did go the wrong way, if you are a debt investor with conviction, you'd be happy to own that business at your creation value. So it's really quite downside protected. And from a risk-adjusted return perspective, I would say better than private equity in this vintage.
One thing that Armin just said, sorry to interrupt, Mike, that's important too when you think about why investors are excited about the asset class now. If you look at this relationship between private equity and private credit, because of the cost of capital, valuation multiples were rising to pretty unsustainable levels in the private equity market. and the debt leverage was not actually keeping pace with it. So if you go to pre-GFC private equity markets, you probably had 30% average equity contribution, which meant that 70% of the risk of that preservation of enterprise value fell to the private credit instrument. Fast forward to today, that number is probably 50 to 60% equity, 40 to 50% debt. And so a lot of this risk is now falling to that equity because there's just so much more equity subordination in it, which is again why I think those that own private credit today are probably feeling a little less anxious than those that are on the equity side.
Yeah,
Just on this topic, I see a huge opportunity in just doing the right thing. It's as simple as that. Do the right thing. If you provide capital in low, moderate income places, if you deliver better employee benefits, you can actually have a lower cost of capital as a corporate borrower and as a private credit manager. You can now partner with SBA and get cheap leverage out of DC. We call our business Lafayette Square because of the park in Washington, DC. Lo and behold, there's a supply-demand imbalance outside of the coast. You can actually get paid higher asset spreads at lower leverage by, again, doing the right thing. Show up in places like Kansas, Louisiana, Alabama, where they're underbanked. And they have phenomenal, beautiful, growing, high-margin businesses that employ hundreds, sometimes thousands of Americans, but their access to capital is compromised. So if you do the right thing, I think you actually have an economic model that is self-perpetuating. On the asset side, you get paid more, and on the liability side, you'd actually fund yourself cheaper and longer.
What about, just in terms of the current climate, the idea that because we now all of a sudden have a lot of safe liquid yield in the world when we didn't have it before, that it's not as necessary to stretch into private markets to grab those returns? Obviously the returns will be higher, but the idea that you can sort of sit back and sort of keep it simple with 6% plus yields in investment grade debt or something like that.
This may be counterintuitive, but Ares manages $400 billion in assets, $300 billion of which is credit. But every alternative asset class, the way to think about investor behavior is trying to generate excess return relative to whatever the liquid market equivalent is. So if you're investing in private equity, you're trying to generate excess return relative to the public equity markets. If you're investing in private credit, you're trying to generate excess return relative to the leveraged loan market, so on and so forth. Viewed through that lens, as long as the private market asset classes continue to generate premium return relative to the actual risk or the perceived risk, people will buy it. So what we're experiencing now, which I think is the proof is in the pudding, private credit, interest in private credit and private credit fundraising is actually accelerating even as rates have been rising because of that durable excess return. And if you're an institutional investor that has an actuarial target, 6, 7, 8%, and you can now generate 11 where you were generating 6, you're not going to say, I don't want the extra return. So there are a few structures where you may have a set of liabilities where you don't have to chase the premium.
Yeah, I've seen some work that says you have,
rare.
Defined benefit pensions are overfunded to a point where they might just...
You may see in certain corners, but that's probably the exception, not the rule.
Got it.
Yeah, and to that I would add, I think obviously treasuries are yielding more than they've had in quite a long time. I don't think it's a bad investment. I think they're good investments. But the excess return in private credit is quite interesting. But in comparison to publicly traded credit markets of equivalent ratings or equivalent risk, I think private credit is more attractive both on a risk basis and a return basis. Now, specifically on the risks, if you looked at older vintage broadly syndicated loans, which are floating rate as well, and also in large part funded in connection with LBOs, those capital structures were put in place at a time when base rates were at 25 basis points. Today they're over 5%. Some number, some tail of those issuers will experience stress or distress. And therefore, just buying the market is probably more risky than it would appear currently, given the absolute return or the yield that is available on broadly syndicated loans at the moment. Whereas in private credit, even in an older vintage portfolio, you really have a little bit more control. You have more of a relationship with the borrower. You're able to negotiate through a down cycle. But I do expect, and I would expect, that in broadly syndicated loans, you are going to see elevated stress and default levels. And with the deterioration in the legal protections in those documents over the last 10 years, I think you will see quite unexpected outcomes. Lender-on-lender violence, the ability for opportunistic lenders to come in over the top of what was once considered a first lien and priority loan. So there are embedded risks that I think will begin to unfold over the next year or two as there is stress in the economy and stress in the markets with elevated rates for a longer period. So it isn't a free lunch. I think I'm concerned right now in the market that everything looks quite healthy and quite good, but feels like a little bit of a head fake to me, and that the economy and the markets could actually experience some trouble going forward. I would be a little bit careful about how you dimensionalize the return on publicly traded debt, especially, because some portion of that should be viewed as a return of capital rather than a return on it. Whereas in private credit, I think some of that is also true, but you have more of the control in your hands as a lender to really be the captain of your own fate.
Just fund wrapper matters. Fund structure matters. And again, I like running toward DC during a period of crisis. Being SEC registered, having partnership with SBA, transparent through quarterly 10Qs, annual 10Ks. I actually think it is advantageous to incumbents in this space because of the trust and the accountability that comes with mark to market, and also, frankly, being transparent about one's goals. You know, Lafayette Square, we've committed in our SEC filings by 2030, 100,000 working class jobs, 50% investment outside of high income places, 50% adoption of what we call managerial assistance or better employee benefits for our portfolio companies. And we're on the hook to do that and make money.
Right.
It's virtuous, but I'd much rather make that statement to the SEC than on my website.
Right. Fair enough. We may have time for a question, so signal if you do have one. But real quickly, what specific areas look ripe to you now in terms of industries or types of capital provision?
Right now, given the capital constraint in the markets, most everything we're doing in private credit is interesting, just given the spread per unit of risk that we're generating. You also have to think about private credit through the lens of performing credit and non-performing credit. On the performing credit side, you're generating very high risk-adjusted return. Volumes are down.
Yeah.
On the non-performing credit side, I think we're still at the front end, to Armin's comment, of what will be a much larger rescue lending distressed opportunity. So I think right now, a lot of what we're focused on is investing into the existing book of business, continuing to accelerate the growth of our winners, and then I think the next wave of what's interesting is going to be distressed commercial real estate lending and some rescue financing. And then last, which is probably what we're most excited about right now, is what we generally call alternative credit, which is all things asset-based, asset-backed, and structured. And the reason that we're excited about that is that's really going to be the biggest beneficiary of the capital constraint in the banking system.
Right. Maybe we'll get to one question here, please.
Thank you very much. Valerie Grant with Nuveen. A question, and this is for Aries or whoever else wants to comment on it as well. Can you talk about the market for private credit outside of the U.S.? We've been talking a lot about what's happening here, but what opportunities are you seeing in Europe or Asia or other parts of the world where you have operations for private credit? Thank you.
Sure, I'm happy to take that. Europe as a general market, if you aggregated those economies, is similarly sized to the US and is very rapidly catching up in terms of level of maturity. So some of the things we talked about earlier, bank consolidation, the development of investment grade and sub-investment grade capital markets, the growth in private equity, those are all accelerating in Europe. So if you go back pre-GFC, the private credit markets in Europe were nearly non-existent. They're now scaling very quickly and look a lot like the US market. And you know, there are different issues market to market in terms of tax and legal structures, but generally the ecosystem looks similar, and the risk-adjusted return opportunity is very similar. APAC is vastly different, depending on developed versus developing. India is presenting more interesting performing loan opportunities. China obviously is presenting more special sits and distressed opportunities. Australia and New Zealand, so you really have to go when you talk about development in the Asian markets. It's really country to country, region by region. But if I had a view 10, 20 years from now, similar to what we saw emerge in Europe, I think you will begin to see a pretty rapid maturation of the APAC region as well for private credit.
We may have another question in front. Yeah.
I'd like to know to what extent you use credit default swaps to enhance or to offset the risk, and also do you use equity kickers in your, for instance, an equity kicker in this particular case would be a spread between the rate that you're getting an interest rate on your loan,
yeah.
But an equity kicker would be a valuation today versus the valuation 5 years from now when the loan matures. You get that spread or a percentage of that return to enhance the return.
I'll take that one.
Yeah.
So credit default swaps, not so much. Equity kickers, yes, a lot. And it's frankly more equity co-invest than free equity. These businesses are open to partnership. They like a debt provider who has the wherewithal to support an equity round, not necessarily lead it. So I think classically you'll see 5%, maybe as high as 10% of a credit portfolio have that basket of equity support for those same companies. And obviously you can grow with your winners, and you hold the line, you're disciplined on the ones that don't grow quite so fast. But exits for equity in these smaller companies is a challenge. And so how do you actually monetize your equity co-invest in these businesses beyond just a put back to the business?
Armin, at the outset, would you look for equity, or is that just in the event you end up owning it as the creditor?
Well, we certainly have owned a fair share of equities at Oaktree, but just through distressed, obviously. But in terms of private credit, again, credit default swaps really non-existent in that. But the equity kickers, you get equity kickers when you go sort of off the center of the fairway. If you go to a smaller business, you go to an industry that is a little harder to understand. We have a very active life sciences business. Most of our borrowers are actually publicly traded. We do get equity kickers more than half the time for free, but that is because the complexity and the structure that goes into those types of more, I would say, complicated situations merits getting equity, because you actually are creating equity value and committing to your loan. When you commit to $150 million for a life sciences company to complete its clinical trials, and you commit another $100 million behind it if they are successful in order to commercialize those drugs, well, you're creating a tremendous amount of equity value, and we often do benefit to some extent through equity kickers in that type of category of lending.
Interesting. Arm, Damien, Mike, great discussion.
Thanks
very much.
Thanks for having me.
Appreciate it.
Thank you.
Gentlemen, thank you very much. Appreciate it. Appreciate it. Nice to meet you. Great.